Well, first of all, I wanted to just thank you for coming on the show. I know you don't have to do this. You know, a lot of CEOs probably rather avoid coming on YouTube channels and stuff. But I know for a fact there's a lot of investment research now goes through social media and on YouTube. The channel that I started a couple of years ago is kind of started on the basis of investing in avoiding the extremely speculative assets that we're seeing run crazy right now, you know, the meme stocks and that type of thing, and picking out really fundamentally good companies, high cash flow companies, and doing that type of investment. So VICI kind of fits into that a bit, I think. But yeah, I appreciate you coming on. I wanted to let you know how I found out about VICI. I went to a trip with my wife earlier this year to Vegas, and we stayed at the Mirage, which I believe back in June, VICI wasn't an owner of at that time. There wasn't the deal with MGM. But we went down there, and I remembered again how nice it is outside of the pandemic to actually see people and do things and not be a hermit living inside the whole time. And Netflix is great, but after a year of just staying inside and watching Netflix, I'm like, this is great to be outside and do things with other people. And then visiting Vegas, I hadn't been there for a while, and I just was again blown away by the buildings, and some of them are so incredible, and they've done, I think on some of them they must have done renovations because they're incredibly impressive buildings, and I just thought this is an amazing place. Another thing that I was thinking the whole time I was there is it's so busy. When I went, it was kind of the end of well, not the end, but it was like a downtrend of the initial COVID variant. And it was kind of before, I think, the Delta variant was taking off. There's this nice little window there for a while where we thought that we might be out of this thing without another variant. So I was there, and they weren't quite as strict on the policies because things were looking really up with the viruses. So we were there, and there's tons of people, tons of demand. We stayed at the Mirage, which is just amazing. But we visited every place there. We went to the Venetian. We went to the Bellagio. We went to the Caesar's Palace, and Caesar's Palace was by far the most packed. When we went there, I was like, "This is insane. There is so much demand," and I was a little bit shocked because there's a predictions that it's never going to come back, and people have moved on, and the world has changed. And I'm going, no, people want in-person experiences, right? Like this is not going to change, but it really, it hit me in person when I was there, seeing how many people wanted to be back to normal. The buffets were completely sold out for weeks. They said it was the most demand they've ever seen. They're open to like max capacity. We went to I think in Caesars, is it a Simon Property Mall?
That's right.
That's the operator of it. Yeah, we went to
the Forum Shops. Yeah.
Yeah, that was a holding that I had at the time, Simon Property. So I recognized it there. I was going, this place is busy too. Like Simon Property and the Caesars were incredibly busy. All the retail was doing amazing. And I thought, I have to own some of this. The investment mindset, even though I'm on vacation, I thought, I have to own some of this, right? There's some good things going on here. So I start doing research on, avenues of how I can invest in this. And a couple different names come up in businesses. And I realized you have the operator side, which are good businesses. But I really was drawn to the real estate side of it, owning the actual land and the buildings, because I don't know, I think there's certain benefits being that type of relationship. But that is how I found out about it. And I actually went on to YouTube and watched some interviews with you in it and stuff, and got a lot of questions answered and that type of thing. And then started making content myself about it. And now a lot of my followers actually own VICI as well. So it's kind of come all from that, I think, that trip in Vegas.
Yeah, well, Joseph, for much of this century, the 21st century, which we're 21 years into, the American consumer was showing right up until COVID an ever increasing preference for the consumption of experiences versus things. And you can actually graph from 2000 onward the degree to which spending on experiences was diverging from the spending on things, with the trajectory of the spending on experiences much steeper, much more positive. Now, of course, COVID came along and it basically shut down the experience economy for a number of months. And in the same way that you can have pent-up demand for goods, you can have pent-up demand for experiences. And that's what you were seeing when you went to Las Vegas. And yeah, there were people who said, oh my gosh, it's never going to come back. And those people, of course, are fools, because almost everything does tend to come back if it is not under secular threat. If there's secular threat, that's a different issue, right? But when there's a one-time event, when the effects of a one-time event go away, life tends to return to what it was like before that one-time event. And you're absolutely right. Las Vegas right now is one of the busiest places on earth. No, in fact, it's probably the busiest place on earth. As an example, the Venetian, which we'll close on the acquisition of here in Q1 2022, in Q3, with nearly 7,100 rooms, it's the largest hotel in America, one of the largest hotels in the world. It ran 97% occupancy for the months of July, August, and September, which, to your point, was a period where the Delta resurgence did hit a lot of the South and the Southwest. And yet 97% occupancy, record operating profit, and all of that despite the fact that at that point, the meeting, conference, convention, trade show business hadn't really yet come back, and will only really start to resurge here in 2022. So what you saw was the desire of the American consumer, because we still don't have a lot of international travel to the US, just saying, to your point, I am ready to go out and I'm going to go to Las Vegas.
Oh, yeah. Well, I saw that in person for sure. I knew there was pent up demand. I've been to Vegas a couple times. I've never seen it that busy and people so excited to be out, though. It was a different feel, but it is good to see that in person, even though, we're not going to live like hermits forever. It's not in our human nature, that can't be something that goes on forever. I have some questions I want to jump into.
Sure.
Just, some of these are with risks with VICI, some investment questions, but I'll go through them. And I'm not a REIT expert, so you probably have talked to people that specialize, that I've interviewed that specialize in REITs, but I apologize if some of these are basic questions.
No apology needed.
First of all, what type of investor would you say VICI is suited for? So if you're looking for a target demographic of shareholder that you're wanting for the company, what are you looking for there?
Yeah, so I think this is true of real estate investment trusts generally, and it will be true of VICI specifically. And just for those of your listeners who are not all that familiar with REITs, REIT stands for Real Estate Investment Trust. And real estate investment trust really became a new category of investment in the US, probably really in earnest starting in the 1990s. And they were established in order to give as many Americans as possible the opportunity to own income producing real estate. And one of the advantages of the REIT model is that federal legislation allows for the income produced by a REIT not to be taxed at the corporate level. Right? So when we have a dollar of cash flow, of profit, none of that gets taxed. And we, in VICI's case, distribute about 75 cents of every one of those operating profit cash flow dollars in dividends to you, our owners. You will then pay tax on that as a dividend. But that's true of any dividend you receive from any kind of entity, whether it's a corporation, a tax-paying corporation, or a non-tax-paying REIT. So what you avoid in a REIT is the double taxation of profit, right? And REITs are really best suited to investors who are focused on creating wealth for the long term. REITs are not a great place to go if you want to get rich tomorrow. And of course, the rich of trying to get rich tomorrow is that you might get rich tomorrow, and then the day after that, you're not so rich anymore because of the volatility. You own REITs for two reasons. You own REITs to receive ongoing income. In our case, we pay about a 5% dividend, a very well-covered dividend that we've grown. We grew at 11% in 2020 when most REITs were contracting their dividends or suspending them entirely, and we grew at 9% again last year. So you get a 5% dividend, and then what you should get year by year. On top of the dividend is capital appreciation as the cash flows of our assets and the value of our assets increase. So let's say we're able to deliver you 5% dividend, 5% growth in the share price for a 10% total return. If you can sustain 10% total return year after year, and if you know the rule of 72, that means within 7 years, you double your money. But if you keep holding it, what you're doing is you're creating long-term wealth that'll be there for you in the term of both income and capital decades from now. If again, you have a part of your portfolio that you want to be a long-term hold in order to deliver long-term wealth creation.
Okay, that makes sense. I guess it depends on the goals. Everybody says they're long-term. We have a lot of excitement in the market though that turns people into short-term, more gambling, right. more the meme stocks and those type of things have a little bit more excitement. But yeah, I really like REITs because my parents grew up owning rental apartments. And while that's great and you can maybe use more like direct hands-on leverage and stuff, I know the work that goes into that. And being able to have you as a shareholder do the work for me is a great thing. I can run the YouTube channel, I can do my job, and then have other smarter people run the business side of it. So yeah, I like that aspect of it. Another question I have. So I looked at the list and actually compiled a list of the amount of deals that you've done year by year. And it's just outstanding to me how many deals you've done. I haven't seen REITs really grow this quickly or aggressively in the past. Maybe I've missed some, but the deal with the Venetian, with MGM Growth Properties, with the Harris locations, expanding in all these different ways. So I have it's kind of a double question, but I have, how are you able to make all these deals happen? Is there any type of, to get this type of deal flow and to be in this, you think there'd be more aggressive bidding and you'd be bid out of some projects and stuff, but it seems like you're able to get these deals above what other companies are doing. And then the other question I have along with this is, do you foresee the growth in the future going along at the same pace or slowing down and tapering off a little bit? What is your kind of feel for the future on it?
Yeah, so this has been an extraordinary year. We're about 4 years old. We emerged in October of 2017. We had our IPO on February 1st, 2018. And during our first 3 years, we did about $9 billion in transactions, which is a lot of transactions. At $3 billion a year, that was a very high velocity growth rate for any REIT in any category. This year was absolutely beyond category. We've done $21 billion of deals in 2021. And the quick answer to your question, are we going to keep this pace up, is no. Okay. Absolutely.
I don't think it's possible, not this year.
Yeah. I don't know that I could do it even if we tried. The key thing to understand about 2021 is that we seized opportunities when they came to market. And as a buyer, you usually do not have control over when great opportunities come to market. So in the case of the Venetian, Las Vegas Sands, the owner of the Venetian, decided last fall to bring the Venetian property in Las Vegas, which I mentioned earlier is, the largest hotel resort property in America with 7,100 rooms, the largest private sector convention, trade show, conference facility in the nation, just a host of superlatives. They decided they wanted to bring it to market because they wanted to concentrate their ongoing capital allocation to places like Singapore and China. Now, there were those who said, this seems like an odd time to bring it to market because, it's somewhat painful to remember, but last fall and going into December, Joseph, we were seeing a pretty dark period when it came to COVID, and including in Las Vegas. So it was a unique period where we and our partner Apollo, which ended up buying the operation of the Venetian, were able to get this deal done without what would have been the normal amount of bidding competition. So it was that wonderful opportunity you sometimes get in real estate investing, which is the opportunity to buy when others won't. Right. And as a result, we got a tremendous cap rate. And for those who don't know what cap rate means, cap rate is simply a way of expressing the yield you're going to get on your investment out of the gate, right? So in real estate, if you make $100 investment in order to acquire $6 of income per year in the initial years, that's called a 6 cap, because you're getting a 6% yield on your investment. It's also known as a capitalization rate. So we were able to buy the Venetian, one of the best commercial real estate assets in America, for a 6.25% cap rate. We were very gratified to get that deal done. We announced it in early March. We thought, okay, now we get to take a little bit of a rest, because that was a big deal. $4 billion deal for us. And then we get a call in, I think, mid to late April, and from the advisor at MGM going, well, we're going to bring the MGP real estate portfolio, the REIT, to market, and we hope you'll be a bidder. And our first reaction was, oh, please, no, not now.
Right now? So you weren't expecting that when you were buying the Venetian. You were caught off guard that MGM was like, okay, we're going to bring this to market too right now?
Yeah. Well, we were a little surprised, because we figured, what's the rush? Let's let more of the COVID cloud clear. But by Q2, it was starting to clear, and the results showed in Q2 2021. Nonetheless, we obviously got to work, and we were very, very excited and very proud over the course of May, June, and July to negotiate and document a deal with MGM and MGP that we think will create tremendous value for our shareholders. You were talking earlier, Joseph, about Las Vegas and how incomparable it is. Well, once we close on the Venetian and once we close on the MGP transaction, we will own 10 assets on the Las Vegas Strip. And not to drown you in detail, but we will own the Venetian, we will own the Mirage. And we can talk about the Mirage in a moment, because it was a very exciting announcement this week about the Mirage. We'll own Harrah's Las Vegas, Caesars Palace Las Vegas, MGM Grand, Park MGM, Excalibur, New York, Luxor, and Mandalay Bay. And what makes us so excited about owning 10 assets on the Las Vegas Strip is that we will own, on behalf of our shareholders will own a incredibly compelling portfolio on what we have come to call the most economically productive street in the world. You saw it firsthand when you were there, right?
The Strip, yeah, for sure.
Yeah.
Yeah, I don't think there's any place that you can. It'd take decades to replicate something like that. Yep. It'd take multi-decades to replicate something like that. In a sense, I've actually, when I did research on VICI, the most comparable company in some ways, and it seems outlandish at first, but I'm like, it seems a little bit like Disneyland. Like, it's kind of like they make these majestic experiences that nobody can spin up a Disneyland, right, overnight. That's not something that can happen. All the assets they have and how unique they are. And I feel like the Vegas Strip in many cases is the same way. It's like an adult version of it, right? So that's kind of a comparison I made. It's a little bit outlandish, but it works.
It may sound outlandish at first, but it totally stands up to scrutiny. Because when you break down that analogy, you go, okay, these are both, to your point, these are assets that would take decades and tens and tens of billions of dollars to replicate, right?
And red tape, right? A lot of
the red tape. And the thing that's not fully appreciated about Orlando and Las Vegas is that these are ecosystems that are properly scaled to handle all of the logistics that go into enabling a place to host hundreds of thousands of people at a time.
Yeah.
Because if a place is going to host hundreds of thousands of people at a time, it begs the question, how are they going to get there? They can't all drive, right? Not if they're coming from all around the US and all around the world. So you need airports that are scaled to bring in hundreds of flights a day. You need transportation systems networks capable of getting people from airports to the resorts. You need resorts that have workforces, employee parking, employee facilities, and laundry, for God's sakes. that can handle, what are there? I think there's well over, I think there's 150,000 hotel rooms in Las Vegas. When Las Vegas is cranking and they're almost 100% occupied, you got to think about, that's 150,000 rooms with 150,000 sets of sheets and towels and everything else. The sheer logistics of this aren't fully appreciated. And again, to your point, it's hard to own Disneyland.
Yeah.
Right. As an investor, as a pure play, right? Because you got to accept the fact, if I want to own Disneyland, I also got to own ESPN and a bunch of linear TV, and I'm not sure where that's going.
It comes with the kind of the cable package, right? It comes with everything.
Right. Yeah.
I've had that dilemma with other companies. I want to buy Warner Media. It's attached to AT&T. It comes in a bundle package there.
Yeah. Yep. With a bunch of channels you'll never watch and don't value. Yep.
Yeah. Well, okay, so deals are going to slow down a little bit after this year. I think that's expected and probably welcomed by investors. These are big, these are big deals. Having it settle down a little bit, I think, is a good thing. Now, I want to bring up, I've been doing, when I do valuation on REITs, it appears to me, and again, I'm no expert on this, but it appears to me that VICI is undervalued relative to other REITs. So if I look at the price of it, based on the speed of growth of its AFFO and the price, versus the AFFO currently, the future expected funds from operation of next year, it's lower than other REITs that are growing slower, which doesn't make sense unless investors are discounting it. And I want to go through a couple of reasons why I think they might be doing that. And I don't know, this is psychology of investors, right? Why are they discounting VICI? But this is the only thing that comes to mind. You might have some other ideas as well. But I came up with 3 different things. One of them would be, obviously, it's experiential real estate, right? And we're in a pandemic. I think that concerns some investors, right? Whether warranted or not. And I'll let you go through each of these afterwards. But with it being experiential real estate in the pandemic, I think that's one concern. Another is the concentration. You named off 10 different properties right in Vegas. And then you have concentration as well in two major tenants, two major businesses, which is Caesars and MGM right now, or you're going to when the deal goes through. And then the third one I think that could cause investors to discount VICI more is leverage, the balance sheet. A lot of other REITs are investment grade balance sheets currently, and that's another point. So maybe I'm missing them, but I think this is the big 3 reasons that I came up with at least. We can start off with, let's start off with concentration. So I know you're concentrated, I think, with around 80% of rents coming in from 2 tenants. Is that correct? From MGM and Caesars?
Yes.
And then you also have geographic concentration in Vegas. So if investors are concerned about that, if they come up and say, hey, I want to invest, but I'm concerned that you're concentrated, and this other REIT says, look, our biggest tenant makes up 2% of rents. We are so diversified, right? And don't go in these ones that have concentration risk. Go with us that have this extreme diversification across thousands of businesses. What is your response to that?
Yeah, so diversification is obviously a time-tested investment strategy, but I don't know how much value there is in the diversification of mediocrity. You're right. A lot of triple net REITs, have tenant rosters in which the largest tenant is, as you say, 2 or 3% of the tenant roster. You also want to understand as a real estate investor, well, what kind of real estate does that tenant occupy? Right? The typical triple net REIT owns what we call commodity boxes, right? These are Dollar Generals, Walgreens, CVS, 7-Elevens. And you want to think about, what are these as real estate? Well, they're usually, in real estate terms, slab on grade, tilt up boxes that are not, frankly, built to last, right? And then as to who occupies them, some REITs do have tenant rosters that are dominated by investment grade tenants, well-known brand names with fully visible, balance sheets, fully visible credit worthiness. But there's also a lot of tenants who occupy these commodity boxes where God only knows who they are and what their credit worthiness is because they're not public and the landlord doesn't have necessarily any access to their financials, right? So you have to accept the fact that when you are diversifying, you are diversifying away from utter transparency.
Right.
Right. So in our case, we do have a tenant roster, as you say, in which Caesars and MGM, the two most dynamic gaming companies on earth right now, do constitute 80% of our tenant roster. Then you add Penn, and then between those three, they're all in the S&P 500. So as an investor in VICI, what you do get is total transparency into, well, actually just about more than 90% of our rent roll, because about 90% of our rent roll is made of publicly traded tenants. One of them that's not is Hard Rock International, which does have publicly traded and publicly rated debt, and they happen to be investment grade. And we're very confident that both Caesars and MGM are on a path to investment grade themselves. So at the end of the day, we're very comfortable with our tenant concentration because of the utter transparency of those tenants and their credit worthiness.
Right.
As far as geographic concentration, yes, we'll have about 45% of our portfolio in Las Vegas. But I would go back to the fact that Las Vegas is one of a kind. If you want to own the best, highest quality real estate, experiential real estate in America outside of Disneyland, Las Vegas is where you own it because there's only one Las Vegas. Absolutely nobody else comes close. And again, it's the most economically productive street in America. And it's within a city that's the economic dynamism of which is just growing year by year. The other thing I would point out is that our portfolio with 55% regional exposure from Lake Tahoe in the west to Atlantic City in the east does give us really strong exposure to really dynamic economies throughout the west, the Sun Belt, and then on up the East Coast and into the Midwest. So again, we will be diversifying over time outside of gaming. We can talk about that later if you wish. But the concentration risk, I don't think is actually the biggest factor. And if you want, I can jump to, I think the factors you cited are absolutely in play. Right. I do think that if you and your followers, if you chart our stock, you will see that up through about July of this year, we were tracking very well in terms of closing the valuation gap between ourselves and the leading triple net REITs.
Right.
When we were first born, we had a multiple gap of probably at least 4 turns. We were getting to the point where the only triple net REITs that had a meaningfully higher multiple than us were Realty Income, a great REIT. It's been around since 1969, and a very dynamic smaller REIT called Agri. What happened in the back half of 2021, which isn't over quite yet, obviously, is that with rising concerns around inflation and interest rates, the triple net sector as a whole began to go off the boil.
Yes. That
is
something I was going to bring up. Yeah, for sure.
Yeah, the triple net REIT sector went off the boil. And what is unfortunate is to be part of a sector that goes off the boil when you, as an individual REIT within that sector, have issued a ton of equity into the market that year.
Yeah. Because
between the Venetian equity raise and the MGP equity raise, which we did in early September, Joseph, we put out $5.5 billion of incremental equity at a time when the market overall wants less triple net equity.
Right. So the dilution and this thing with the inflation and the triple net lease rate hit that it took, you're saying both of those was kind of like a double whammy at the same time?
Exactly. And it's, the key thing to keep in mind is it's temporary dilution especially because when we issue equity, we generally issue it in the form of what are called forward shares.
Sure.
They actually don't count against our share count until we settle those shares.
Okay.
And take in the money at a time when we're about to close on an asset that will immediately start producing income. But that's a nuance that a lot of the market doesn't care about. They think, oh yeah, there's a whole bunch of new equity. They don't have the income yet. I think I'll just sit back and wait for them to close these big deals, and then I'll really start paying attention again, because I'll know what the AFFO per share will be.
On that note, just skipping around a bit, do you think with inflation being at like like 9% or something, it's like up like crazy, and it seems like the Fed just announced they're raising interest rates. I know people you can kind of judge it in two ways. You can say it's a good thing you have long lease terms. They're like above 40 years, right? So you have these longer leases, and that's good because you have tenants, right? You want to have tenants for a long period of time. So as long as they stay in business, you basically have tenants for the next 40 years, which is really nice as a landlord. On the flip side, though, if you're thinking about, these 40-year leases, and is there some duration risk there, like you'd have kind of with bonds, with interest rates going up and with inflation going up? Is that the big concern there? How do you view that?
Yeah, so it is a real risk when your leases do not have any built-in contingencies around inflation.
Okay.
And you're right, inflation's high right now. The 9% number you're referring to, Joseph, I think is the producer price index number that came out earlier this week, which does not constitute consumer inflation per se. But consumer inflation, you're right, it's 6%. Is that like
6% or something? Yeah.
Yeah, it's high. And time will tell how transitory or not it is. We do somewhat uniquely as a triple net REIT, we do have a critical mass of our rent roll with leases that involve inflation protection for us as a landlord. So as an example, with Caesars, we have two leases. We have what we call our Las Vegas master lease and then our regional property master lease. Our Las Vegas master lease has what we call a CPI kicker, in that the rent escalates every year at a minimum of 2% or CPI.
Okay.
Right? And the higher of, I should say. So our rent on our Las Vegas master lease actually escalated nearly 5%.
Oh, wow.
As effective as of November 1st. Next year, our regional master lease will go to the higher of 1.5% or CPI uncapped. So if you take 40% of our rent roll, we have uncapped inflation protection built into the leases. That is very unique among triple net REITs. Only WP Carey among triple net REITs really has that kind of inflation protection in a meaningful part of its rent roll. Beyond that, we have another 20% of our leases that are the higher of either 1.25% to 2% or CPI up to a cap of 3%. But at least then, year after year, we're at least getting 3% escalation in our rent, which should, in most situations, keep us at least even, if not ahead of inflation. And then once we get to year 10 in our relationship with MGM, we will go to the higher of 2% or CPI up to a cap of 3%.
Okay.
What that all adds up to is we'll have a rent roll that's about 95% inflation protected. So relative to a lot of other REITs that tend to have either longer leases or, especially those with longer leases, we do offer a greater percentage of inflation protection.
Okay. So you're hedged against that a bit with the portfolio.
Yeah.
That's what I thought, because if you didn't think about this stuff beforehand, writing these agreements, you could get in a lot of
trouble.
Too
late now.
Yeah, it's too late now.
Yeah.
Can't go back. Yeah. And nobody can say how long inflation will go. Everybody's guessing. It's a fun game to guess, but nobody knows. There is
a great adage that you and your followers have probably heard, which is the best cure for high prices is high prices.
Yeah.
There does come a point where prices get out of control. The consumer tends to step back and say, sorry, but I'm not paying that.
Yeah.
And the next thing you know, you get a surge in supply as demand decreases, and you tend to re-find equilibrium.
Sure. No, I think, I don't think we're going to have this level of stimulus forever. So
no.
It'll go down eventually. The other things, I guess the bigger concerns investing in VICI, something people would look at would be, we talk about the tenant concentration, talked about inflation. What about the big thing with going back to tenant concentration? Not a big thing, but one thing that I've heard from a few people. I'm not personally super concerned about this, but it is something that I've heard, is the drought in Vegas. Is that a concern or something that you consider at all? Or is there anything the casinos are doing with that? Is it something they're concerned about?
Yeah, well, again, this somewhat goes back to places like Las Vegas and Orlando being very special ecosystems where there's a higher degree of unanimity over what makes the location successful than you typically find in so many jurisdictions, right? And one thing that we're really impressed of and really proud of on the part of our partners in Las Vegas is that in 2020, water consumption in Las Vegas was 42% of what it was in 2002.
Yeah.
That's not per capita. That's aggregate absolute water consumption in Las Vegas, again, versus 2002, despite the fact that Vegas has obviously grown tremendously since 2002. They take water resource management very seriously there.
That is an incredible.
It is. In fact, there was a piece on NPR in which some commentator who really focuses on environmental management made the point, Las Vegas is way more progressive around water management than Portland, Oregon is, as an example. So no, they take it very seriously there. And it's not really just to do with drought. It has to do with the overall sustainability of the Colorado River water system and the sustainability of Las Vegas itself. And even beyond water resource management, we were very excited and proud when MGM, who's soon to be our partner, opened up this past summer a 330,000 panel solar array in the desert about 30 miles off the strip, which will produce up to 90% of their daytime electric needs in Las Vegas.
Really?
And so, yeah, we're very proud of the fact that companies like Caesars and MGM are incredibly serious about making sure Las Vegas is sustainable.
Awesome. No, I've read the same things. When I was doing research on it, I thought, wow, they really are so much more efficient than most people realize. They see the big casinos, they might see like the Bellagio fountain and be like, this is a waste. But then you don't realize they get that water from some other place. It's not taking away from the city, and they're incredibly efficient with running it. But so another thing is on the subject of risks with the investment, right? One of them is, we talked about in-person experiences. Obviously, I think demand is going to come back. It is there. Demand is there for in-person experiences. And people are just, I felt like there is this big positive kind of movement when the initial COVID virus was going down and there wasn't the Delta anymore. But now we have the Delta that we've gone through, and that's kind of going away. And then we have Omicron that we're going through. It's unpredictable, and I think some investors are concerned about that in terms of the what is it called? The convention business. So I know VICI owns, I think, the largest amount of convention square footage in like the US, right?
Mm-hmm. Yep.
How do you think about this? Is it something where is the convention business, when are you expecting it to return over time? What are your thoughts on it overall going forward from here with kind of the uncertainty with all these new variants, and who knows when this is really going to end?
Yeah, you are absolutely right. We are the largest owner of private sector convention space in America, and with a lot of that obviously in the Las Vegas Strip, as well as other great assets like National Harbor in Washington and Borgata in Atlantic City, Harrah's Atlantic City. And we do have a high conviction about the return of conference business. It actually started for us, Joseph, when we're doing the due diligence on the Venetian, and with our partner Apollo, we retained Bain to do a proprietary research survey of America's meeting planners. And in January and February of 2021, earlier this year, when the outlook still was very murky, what they found in talking to meeting planners was a very high conviction on their part that their clients were going to come back. And that's also reflected in the forward bookings in Las Vegas for 2022 and 2023. The conference bookings in 2022 in Vegas are very strong. And what we've seen even in the last couple of months in Vegas has been very promising. There's a big organization called the International Conference of Shopping Centers, ICSC. Okay. And they held what is usually a smaller conference in Vegas. They normally hold it in New York. They got 10,000 people to show up for a conference that usually draws in the low thousands. Wow. CES, God willing, is going to go ahead here in early January. It won't necessarily be the 150,000 person conference it normally is, but there's going to be a lot of people. And it does have to do with that same pent up demand to gather. So much of America runs on selling. And when you sell, you've got to get in front of your clients. You got to get in front of your customers. And I think there's a recognition that conferences, trade shows, conventions are a very efficient way to do that. The other advantage Vegas has is that Vegas did not kind of turtle when COVID broke out. They did not send their sales teams home. And Vegas did not become semi-apocalyptic like some other cities did, right? I mean, right now, I feel badly for the convention salespeople of San Francisco. They had a really bad break this week when JP Morgan pulled the plug on their healthcare conference, which draws tens of thousands of people. There's a lot of meeting planners who are looking at the situation on the ground in San Francisco and going, I can't send delegates here, right? That may correct itself, but given the booking lead times that tend to associate with big conferences and trade shows, conventions, it'll be a while. And Vegas is being advantaged by that in terms of having better facilities, better sales teams, and just a growing recognition that it's an epicenter of American culture. That was borne out this week when the NFL said the Super Bowl is coming in 2024. The NFL draft is coming this spring to the asset that we will eventually own, the Caesars Forum Convention Center. So Vegas is definitely capitalizing on its scale and its quality to grow greater and greater market share of not only leisure travel and spending, but also business travel and spending.
Awesome. I don't think it's gonna. I certainly think there'll be demand until people feel, eventually. I think eventually, the pandemic's gonna end. People think things are gonna go on forever. I think it's gonna end eventually, but it's amazing. I think how strong they've been in the meantime, even with certain concerns and stuff. Navigating through this, it's been pretty incredible.
It has.
And then the other thing I had was leverage. So, I know anytime I look at an investment, I check out the balance sheet and try to look at what type of risk I'm taking on here in terms of leverage of the company. And I know VICI right now does not have an investment grade status, right, on the balance sheet. But that's something you're working towards. Do you have any, I don't know, any type of insight into the timeline or when you think that might happen? I know that it's some of it is stuff you can't predict, but your goals and working towards that.
Yeah. So it has been our goal since the beginning, even though we were born with a lot of leverage and some slugs of debt that were quite costly and restrictive. It's been our goal from the beginning to get to investment grade. And for those of your followers who want to see firsthand where we stand in this, there is in our current investor deck, which can be found at VICIproperties.com, a page or two in there about our path to investment grade, and in particular, quotations from both S&P and Fitch, the rating agencies, expressing their opinion that if VICI's capital raising over this period, these notes were put out in August and September, that if VICI raises sufficient equity in order to be under 6 times debt to EBITDA by the end of 2022, we S&P and Fitch are likely to upgrade them to investment grade.
Okay.
So with the equity raise we did on September 8th for $3.2 billion, that pretty much guaranteed that we don't even have to wait until the end of 2022 to be under 6 times debt to EBITDA. We'll probably be at about 5.9 net So our belief is that it should be sometime in this year,
right,
concurrent probably with the closing of MGP, that we will be elevated to investment grade. And that'll be very powerful, very meaningful. The other thing I think, though, that you and your fellow investors really also want to always focus on when it comes to the debt of a company is how effectively laddered is that debt? Because it's not absolute debt that usually gets a company into trouble. It's having a big amount of debt come due at a highly inopportune time.
Right.
And we have worked very hard on our laddering and will continue to work hard on our laddering so that eventually, we're not quite there yet, eventually we will have maturing in any given year an amount of debt that if we had to, we could pay it off with the cash flow produced by the business before dividends. If we had to suspend the dividend or if we had to pay the dividend in shares, we would do it if paying off that debt enabled us to fight another day. Because we certainly saw in the great financial crisis that it was debt coming due at the wrong time that really got people into trouble.
That's what, that's, I think, what gets most companies. You look at any company and there's other factors. It is competition, inopportune time, recessions, but it's always a mixture of a large amount of debt coming due at the same time. So I think that's the big concern with any investment if you're looking at the business strength and the underlying fundamentals. But that's something. So you're going to become less levered over time. I know you've gotten rid of some of the, what do you call it? Like the bad debt, right? You've gotten rid of that recently. But those are good. I think good adaptions with the company over time to look forward to. Does it change the calculation when you become investment grade? What does that do in the investment world? Does that allow it into more funds, or does that attract more capital? Does it have, it might have it so you can get into the S&P 500 or something? Like what does that open up opportunity wise?
Yeah, the most fundamental benefit of going to investment grade is that the cost of your debt is lowered.
Okay.
Right. And generally speaking, so right now we are double B at S&P.
Okay.
At the corporate level. If we go up to triple B minus, which is the lowest grade of investment grade, we will probably enjoy from 50 to 100 basis points, so from half a point to a point of lower cost debt at, say, the 10-year maturity bond profile. So it's very meaningful savings on interest expense, which has the most beneficial effect of lowering our cost of capital.
Okay.
And generally, it's quite virtuous that when you get to investment grade, not only does your debt get cheaper, but your equity gets cheaper too.
Right.
Because equity investors are willing to give you a higher multiple because you have a lower cost of capital. It is, again, that virtuous cycle. That in and of itself won't necessarily have anything to do with admission to the S&P 500. There are non-investment grade companies in the S&P 500. That admission to the S&P 500 will be a consequence of our reaching a size where S&P, in its wisdom, and it does not make the methodology of its wisdom public at all, and it doesn't make its timing public at all. But we will be one of the 5 largest, what we call four-wall REITs in America once we close everything. And we will be much larger than a whole bunch of REITs already in the S&P 500. So that'll have if we get admitted, and we're hopeful we will before too long, once everything closes, that'll have a very beneficial effect too, in terms of creating even more index demand for our shares.
Sure. Yeah, it sounds like, I don't know. It sounds like there's a lot of catalysts up in the next couple of years. When I look at the company and the path of it, it sounds like a lot of good things in the future. Now, the other thing was, one thing I wanted to mention. I watched an interview with Bob Chapek, the CEO of Disney, and he was asked about ESPN and gambling in addition to ESPN, and he was very welcoming to it, which kind of surprised me because it's like the Disney brand, but no, they're embracing gambling, especially with ESPN. And I just want to know how the leadership of VICI thinks about this. Is it competition? Is this a bad thing? Is it a good thing? What does this mean in terms of Vegas and casinos in general? Not even just Vegas, but casinos kind of being a place to go and do gaming and sports betting. Now that it's being more widely accepted by CEOs that previously weren't really that accepting of it. What are your thoughts on that?
Yeah. So let's step back and recognize that our gaming tenants operate in the consumer discretionary sector. There's a fundamental dynamic at play at all times in the consumer discretionary sector. If you're competing for consumer discretionary spending of time and money, you must start with share of voice. In order to get your you need to get your message out as widely, deeply, and frequently as you can, because by growing your share of voice, you grow your share of mind. And when you grow your share of mind, it means you are more likely to win the decision-making process as that consumer decides where to spend their time and money. And thus you gain share in the spending of time and money. So again, grow your share of voice to grow your share of mind, which then grows your share of market. Well, there's two great conversation topics in America that the widest swath of the population can take part in: weather and sports, right?
Right.
And we can't even, frankly, have a national conversation about weather anymore without it breaking into political battle.
Yeah.
As to whether or not, geez, was that man-made or not?
Yeah. Right.
Sports is like the one national conversation we can have. And what sports betting is doing is giving our operating partners, Caesars, MGM, Penn, Hard Rock, Jack, Century, Eastern Band of Cherokee Indians, it's giving them all a chance to participate in the national conversation of sports in a way they were never able to do so before across so much of the country. And what we think it's going to do is have a very powerful effect on the audience expansion for American gaming, because it's going to make a lot more people interested in who is Caesars and why is JB Smoove in my face all the time. What's it, come to think of it, I do want to do some sports betting. I'm really excited about March Madness, or I'm excited about the Super Bowl, or I'm excited about Tom Brady and the Buccaneers, or I hate Tom Brady and the Buccaneers, so I want to bet against them. That we think will expand the audience for American gaming in the same way that ESPN and regional sports cable massively expanded the audience for pro and college sports. Right. So again, that's the most important dynamic we think in play. It is this audience expansion based on high audience engagement. And when Bob Chapek, the CEO of Disney, talks about sports betting being integral to ESPN, he's being very open and honest about the fact, in order for ESPN to continue to grow engagement with its audience and expand its audience, it has to participate in the sports betting conversation, which it currently does with its partner Caesars. Right. But that all could grow in ways I wouldn't even want to start to anticipate.
No, I think that's very true. I feel like the whole pie is going to be expanded as well. It just attracts more attention to it. But I was interested the way that you view it. You talked about the institutionalization of experiential real estate on one of the earnings calls. What do you mean by institutionalization? You're saying the way that I saw this was that you have a lot of like REITs that are in very tried and true industries, and VICI is a little bit more niche, and like it's like the big institutions really haven't caught on that this is like a really investable place. But I don't know. I was very intrigued by that.
Yeah, you understood it exactly right, Joseph. If you look across the real estate investment spectrum, there's categories that are very well understood and generally very well supported. So office has been around a long time. Apartment REITs have been around a long time. But if you look at some of the hottest categories, they're actually fairly new, but each one of them needed time in order for institutional capital to understand them. Institutional capital only invests in what it understands, but it can only gain understanding if it takes the time to do the work of learning about the category. And that takes time, in part because institutional investment houses, like so many businesses are spread so thin.
Right.
There's analysts and portfolio managers asked to cover such a wide swath of investments. I have no idea how they do it. Right. So as an example, industrial is hot as a pistol right now, especially anything to do with final mile logistics. That only really got going in the last 3 or 4 years. It took a long time for people to understand data centers and why they were good real estate. It took time for single family rental to legitimize itself. It took time for manufactured housing to legitimize itself. And the gaming real estate sector is one of the newest sectors of all. And we're still in the early stages of investors learning about the sector. But as the learning grows, the valuations will grow because the investment in the sector will grow. Sure.
No, it makes sense. That was an intriguing thing. I hadn't really thought about it that way until I listened to that earnings call. The last thing I have for you is what are you most excited about in the future? What is the thing you're looking forward to the most with the company?
Yeah, I think probably just continuing to participate in the continued growth of the experiential economy in America and around the world. Right. I think if you look at the big demographic waves, the aging of the baby boom, millennial family formation, these generational age waves are going to manifest themselves in ways that continues to drive this increasing embrace and pursuit and embrace of experiences. And whether it's in gaming or non-gaming, we think there's tremendous secular tailwinds behind the experience economy. And we want to be a real estate owner of choice for out-of-home, place-based experiences that Amazon can't put in a box or send through a wire to your house and dislocate the real estate.
What do you see as the most promising things outside of gaming?
Whole lot to do with basically entertainment, sports, fitness, recreation. Again, experiences you just can't do in your own home,
sure.
Right? We have an investment, as an example, in Chelsea Piers in New York, a massive recreation facility on the Hudson River. And, you know, it is refinding its membership base like better than anyone could have hoped because of that desire to get out of my house and do things I can't do in my house. Can't do it on a Peloton. I can't do it in a mirror. These are things, whether it's the hockey rink, the golf driving range, the massive wall climbing area. These are the kind of things that we really want to be investing in going forward.
Well, awesome. That's all I have for you. And I really want to thank you again for coming on. I really appreciate it, Ed.
My pleasure, Joseph.